When you become a full-time real estate investor, you're not seeing a lot of cash until that you really start exiting some properties or refinancing. So when you're first starting out, you're looking at like a 5-year period. You will be getting some cash flow. So be mindful of this. You're becoming an entrepreneur when you become a full-time real estate investor.
Welcome everybody. My name is Danielle Unsworth and I have with me here Adriana.
Hi everybody, I'm so excited to be here. Thanks for coming. Obviously, this is a topic that's near and dear to my heart, so I'm excited to share some things with you guys tonight.
Awesome. So before we get started, there's always a disclaimer. So just so you guys know, we are real estate investors. So we're not like accountants, mortgage agents, lawyers, or realtors. And what we're showing and teaching in this workshop is based on our own personal experiences after many, many years of real estate investing. So before you take any action, make sure you do your own due diligence, your own research, and speak to professionals, and so that they can give you guidance based on your specific circumstances. And today what we're going to cover, how to find these deals, these apartment buildings. And then we're going to go over the due diligence process and what that means, what to look for. And then we're going to talk about the difference in commercial financing and residential financing. And then we're going to talk a little bit about active investing versus passive investing, what those roles look like. And then we're going to have our Q&A. And then we'll do a case study for you, which is a live deal that we have right now. It's a 50-unit deal. And then you can see what those numbers look like and ask those questions in meetups.
Awesome. Thanks, Danielle. I've been to a couple of the WINC meetings and they are really great. So I encourage you all to check it out. My name is Adriana Ostapenko. I fell in love with real estate, started investing full-time since 2016. We come from a construction background. We have a family construction business. So we focused on doing value add multifamily, started on the smaller multifamily side, mostly fourplexes, and now grew to a soon-to-be portfolio of 94 doors in the multifamily space as an active partner. So it's very exciting to be growing so fast. I've created ACE Properties as really a way to give back and provide opportunities for other investors that want to get into the space. ACE Properties does a few things. We focus on wealth generation. So we're here to build wealth for ourselves, but also for our community and reach out to others as well. We're here to provide opportunities to other investors to generate wealth themselves. I've been so blessed and grateful to be in a position to have, impacted so many lives by providing these types of opportunities for investing and being, on the managing side. We also do education. So we do multifamily real estate education as well and provide opportunities for other investors to learn about the strategies in real estate out there. I do believe this is prime time to buy real estate. This is a type of a moment in the market that we all as real estate investors wait for. So we'll talk about that a little bit as well. And lastly, we do impact. ACE Properties is a for-purpose business. Part of our mission is to give back to the current communities that we invest in. Last winter, I was blessed, and ACE Properties was blessed to be able to provide housing through a government program for those that needed to be out of the code for 6 months. So that was a unique experience, and we're going to continue to partner with local organizations to provide overall bad improvements to communities where we invest. So I guess we assume that once you've been looking at a property, a couple more tips I'm going to add in there is, one is focus on a specific area. The reason is you got to learn that market really well. What we've done when we're doing our BRRRRs, we just focused on an area where we knew the zoning would allow us to do. We were doing conversions to multifamily. What I loved about that was I got so like, I knew the area so well. I became an expert in that area that I was just able to move quickly through properties. I started getting to know everybody. So you got to reach out to your team, like Danielle said, realtors. I also do property managers. I reach out to, brokers, lawyers, like you're kind of talking to everybody and getting to know who is playing in commercial real estate in this area. I kind of need to know them and they need to know me. So we started having those conversations. Once you find that deal, I also find people ask me all the time, there's no deals out there. I say, I have never had a problem finding a deal as long as I'm consistently looking. So whenever I'm in acquisition mode, I'm looking at deals and underwriting them every day. Every time I'm going through that process, I always find a deal within, a period of time, just from the consistency of it. And it helps to focus on that area. Once you've gotten the building under contract, now you're going to start your due diligence process. And this is something that's, unique to the commercial space and ends up differing quite a bit from the residential side of things. So let's talk about underwriting the deal and what that looks like. What am I looking for in my numbers when I'm underwriting a commercial property? There's a few things that I'm going to be really focused on. One is cap rates. That's very heavy how we underwrite multifamily deals. On the cap rate side, every city is different. Every municipality, every province will have slightly different cap rates. A really sweet spot for cap rates is about 5 to 7%. Okay, that still means there's appreciation in that market, but it's cash flowing. Anything really much higher than that, now you're looking at a high cash flow but low appreciation. Anything much lower than that, now you're looking at maybe a high appreciation but no cash flow. So that's really a sweet spot where I look for in there. And so I'm looking at cap rates. Next thing I'm looking at is the debt service ratio. That's pretty standard across commercial real estate. Most brokers are looking for 1.2. Most lenders are looking for 1.2% debt service ratio in your building. That means that it has to be servicing all the debt in the building and still making you some money. That's how the bank and the lenders protect their asset and their investment into your building. So that's something I look for immediately. That's also going to help you decide the valuation of the building too. Next, you're looking for NOI. So that's your net operating income. That's really important. It's really all the income minus the expenses except your debt service, which is your mortgage payments. So that number is going to come into play as you're doing all these calculations as well. The next two measures I'm looking at is cash flow and ROI. Now, Ace Properties operates under a few guidelines. Whenever I put an investment deal together, I'm looking for cash flow that's going to allow us to do, a minimum of 6 to 7 cash on cash return. And that's because we like to give our partners at least, depending on the market, at least a 5% cash on cash return. So we're looking for a cash flow that's going to allow us to do that, even if it's after renovations, which is something that we do the value add strategy as well. And then I'm looking for ROI. So as real estate investors, we're always looking at what's the return on my investment. If I were to invest $100,000 here, what am I getting back? That's the next measure I'm looking at. I like to target 18 to 20% on any investments that we put out there. So that's kind of the major numbers that I'm looking at when I'm underwriting a commercial deal. Once I feel confident enough with the, Kim, if you want to put your question in the chat, or maybe you already have, let me check through there. And then I'll answer it for you. Once you've read my numbers and I feel confident, the deal is on the contract, we're going to go do a walkthrough of the property. In a walkthrough, there's a few specific things. Somebody recently asked me, they're putting 100 units under contract right now, portfolio, and they were asking, do you go and look at every single unit? So my answer is no, I do not. I don't go into every single unit. I do try to go into a mixture of units. So I kind of want to see the different layouts. I want to see the different bed counts. And so I'm getting distracted with the questions. Maybe I'll have you read them to me after. And so I want to see like a good assortment of units. I also want to see, show me the worst units, show me your better units, show me anything that's been renovated, show me anything that needs a lot of work. And I make sure the inspector goes and checks that out as well. But I'm looking for major structural things. So I'm looking at the roof. I am looking at any structural damages. Now, I can't always tell, but there's also really clear signs when there are structural issues in a building. You're gonna see water pooling by your foundation. The building may be slightly slanted sideways, windows or cracks in the building. So there are signs of structural damage. Stairs by the front door may be slightly shifted over. So there's many things that you can check out before your inspector gets there as well. I'm looking for windows. Biggest difference is, are they vinyl? Because vinyl windows are newer windows. They may not be very, very new, but they're newer versus the original windows that you would see in a lot of the earlier buildings. I'm also looking at utilities. Do they have separate meters? What's the condition? What's the age of the service room? Are we going to be needing to do an electrical upgrade? Are we going to be changing a boiler? Because these are massive costs, as you can imagine. I'm interested in bed counts. Hey, how many of each unit do we have here? Because that's going to help me decide the rent and what we can get for it. And then I'm looking at some more like softer type of analysis. I'm looking at the tenant profiles in the building. If I can run into tenants, that'd be great because I get to have a conversation with them. That's my usual best way to get information is chatting with tenants who live in the building. I'll ask them directly, how do you enjoy the area? Do you like, the building? Are there any issues that you like to talk about? How do you like the property management? And really being able to have those conversations with them as well. With that, I'm looking at the area too. How do I feel when I'm there? Does it feel safe? Does it feel comfortable? Now, we do invest in areas that are mostly on the B side, C to B, because we're bringing value to these buildings. So we're comfortable with certain areas as well, but that's something that you want to be on the lookout for. What's around? Is there a gas station across the building? Because that could be bring some environmental issues. Is there a body of water? That's another thing that brings environmental issues. So you want to be sort of looking at those things closely when you're doing a walkthrough. In terms of property inspection, I always get one. I think any realtor lender will gladly ask you to do it. I build relationships specifically specific inspectors as well. Again, another reason why focusing on one area helps you out because you can build those relationships with your team members there. We always negotiate something. I don't think we've ever closed on a building that we didn't negotiate it at all. And we're negotiating, it could be different things. Most often, obviously, we're trying to hit that price point and try to lower it. I'll give you an example, and we're going to talk about our 50-unit deal, but that's something we did do there. As we were doing our due diligence period and going through, inspection, we got appraisal back, we did walkthroughs, we looked very closely into a lot of things, and we found out some interesting things. For example, they had given us the wrong bed count. They had told us there was more T units than there actually was. It wasn't by a lot. It was 2, 3, 1 bedrooms that they told us that were 2 bedrooms, and there were 2, 3 bachelors they told us were 1 bedrooms. The fact that we caught that affects our NOI quite heavily, and we were able to negotiate a price decrease based on that. And a bunch of other items as well that we noticed. Mostly sellers tend to misrepresent information that they give us in terms of expenses. We make sure to check those very closely, and I can probably talk in another slide of how I do that. But we write an email to the seller. We explain everything that we found on the property, how it impacts our numbers, and the fact that we do need to negotiate something. You can negotiate price, you can request, and that includes potentially requesting a VTB. You can negotiate terms, and that's, hey, we're going to need a few more weeks of extension because, we had some delays in getting information from you, or whatever other things it can be. You can negotiate the timelines on the deal as well.
Adriana, do you want to go back and just maybe go over VTB quickly, just for those who don't know what that is?
Sure. So a VTB is a vendor take back, which is when the seller themselves give you a loan on the building. Usually gets registered as a second position mortgage on your property. What that does is it diminishes the amount of money you have to come up with for the closing. So in this case, we originally had negotiated a VTB. As our negotiations went along in our 50 unit, we ended up switching that and getting an even larger price decrease on the property instead of a VTB. Something to be mindful of VTBs is lenders don't always love them, because no first position lender wants you to have a second position mortgage. So be aware of that and have that conversation with your lender sooner rather than later and say, hey, we are talking about a VTB in this property. This is the amount we're thinking. Trust me, they're not going to love it. But you know right away if they're willing to work with you, knowing that there's going to be a VTB in your property. Yeah, something I wanted to say about passive versus active is, real estate is an investment vehicle. I think we all know that. When you become a full-time real estate investor, you're not seeing a lot of cash, until that you really start exiting some properties or refinancing. So when you're first starting out, you're looking at like a 5-year period. You will be getting some cash flow, but it doesn't provide you always the amount of funds that you need to be, one, running a business, two, to be supporting your family, especially with the cost of everything. So be mindful of this. You're becoming an entrepreneur when you become a full-time real estate investor. A lot of people will keep their active income going for a long time. And you are running a business. So you got to be mindful that you need employees, you need team members, you need a lot of hours and effort to actually make it, a profitable business for you to survive, as well as grow your portfolio for the long term. Something to consider there. And then in terms of the roles here, and who provides what in the deal, as an active partner myself, personally, so something, and I'll give you an example about our 50-unit deal and what that looks like on my end. We've been working on this deal for close to 4 months now. From the moment we first got into it, we came across throughout due diligence process. My business partner and I have already invested upfront about $150,000 into this deal. That's funds that we are putting in as upfront costs, from lawyer costs, inspections, appraisals, deposits, due diligence, time and commitment of 4 months that we put into this deal already. The other thing that we're providing here is we're qualifying for the whole mortgage amount based on our net worth, as Danielle explained earlier. You also have to have good credit, by the way. That's another criteria as, an active partner that they will look into. I just recently met with an investor who was trying to purchase some buildings and cannot qualify just because of his credit history. So keep that in mind. With our net worth, we're able to qualify and secure and personally guarantee the loan in this project as well. And then all the work that has gone into putting it all together and ensuring this is a really solid deal that we're very excited about to bring to investors as well. For the passive investors, you can imagine, first of all, I like to build relationships with our investors. To me, this is about a long-term partnership, because that's what it is. We're looking at a minimum 5-year partnership together. But I like to build relationships because I would love to reinvest with you. And that a lot of our investors will reinvest into future deals as well. Danielle is one of them. That's how we first met. She's invested passively in our deal, and then she's invested in a different one. And now she's here and on the active side as well. And she does other active deals with other partners too. It's really hands-off and passive for people, for financial investors, which is great. You put your money to work for you. We are doing a value add. We do a lot of value add because that's what changed my life. What changed my financial life and my financial future was being able to do value add opportunities. We focused on doing BRRRRs for the first 3.5 years, and it really changed our lives for the amount of appreciation we're able to cause on a property. Also, because of our construction background, we're really comfortable with the renovations components. When I say that, a lot of people say you're lucky, and I am. We have been blessed, and I'm grateful that construction is our background and allows us to focus on properties that need work and be able to uplift them and offer that appreciation right away. The biggest benefit of a value add opportunity is that you get some of your cash back much sooner than you would otherwise. So that's receiving your back investment here. As a passive investor, we give your funds back before we get any profit sharing. So this way your original investment is, you know, as secure as it can be on the asset that gets paid back before we really share any profits. The other things that we do is we provide quarterly, it says annual year, but we actually do quarterly financial reporting and updates on the projects and things that we're doing. And any property improvements and the whole process to you as well. So you get to learn and be part of it from the beginning of the project of, hey, how do you run these numbers and how do you calculate this? I also suggest it's a really good way for you to do your first multifamily deal is by partnering with somebody that has experience. You know, do your first deal passively so that you can learn the process of like, how do you put it all together? What kind of presentation do you do? What's the deal look like? And what's the legal paperwork involved in a GP/LP structure? And then, you know, what does it look like to maintain and operate this building on the long term as well? Oh, I feel like I covered both in the one slide.
Yeah, that's okay.
I can touch upon a couple of things. We have, in terms of execution and exit strategy, every deal will be slightly different. Because they are unique in nature. We do have, you know, regular guidelines that we use to operate any of our deals, but we do have different exit strategies. Usually it's a 5-year timeline. On our 50-unit live deal, it's a 7-year time span. The reason being is we have a 2-year construction time where we're doing the value add strategy. You get to refinance and get some of those funds back. And then we hold the property for the next 5. And enjoy the cash flow and appreciation that's going to come from that as well. And then we do, in terms of operations, this is the heaviest part of the investment for the active partner. I talked about the due diligence period being like 4 months and the upfront costs that goes into that. But we're operating this building for the next 7 years. There's project management involved, there's property management involved, there's operations. My business partner and I meet weekly where we go over what's going on in our properties. We go over monthly financial overviews. Are we hitting our cash flow targets? Where are we with vacancies? Is there anything that we need to be looking into? Should we be increasing rent? So we're always constantly operating this building, and that's a commitment the active partner makes for the lifetime of the deal as well. And then we handle everything to do with the property. If there's to get financing, to refinance the deal, to filter investors through, provide any legal documentation that's needed. We do accounting, financials, bookkeeping. So as we said earlier, it's a full-time job. This is an active business that we're in, which I personally love. I know Danielle does too, and it's been really life-changing for us. And that's the question that you need to ask yourself. I feel like a lot of us get into real estate because we want time freedom. And we don't realize that by becoming a full-time active investor, that is not what you're getting. Now you are getting, you know, financial freedom in the long term, which is amazing. This is why we do it as well. But in the short term, there's quite a bit of work involved to put it all together. So I guess we had lots of questions. Was there anything else?
Okay, so essentially, just to recap, because we've come to the end here, and that's how you buy apartment buildings. So it's not as hard as you think. So essentially, we've taken you from like how to find a deal, you know, what numbers to look for, how to negotiate after, you know, doing the walkthrough and the property inspection, and then a little bit about the financing. So I can go over the questions, or we can do our case study first. So that way, maybe everybody gets a picture of what the whole thing actually looks like in action. And then we can go and answer all the questions in the chat, because maybe some of them will have been answered through our case study. So yes, maybe let's do that. So let's talk about our live deal that we're closing very soon, and then just show everybody how you know, this deal was put together and what the numbers look like.
Yeah, amazing. So yeah, this is a live deal we've been referencing. I love that we have a live deal and a case study to kind of talk about the details of what it looks like. Honestly, every deal is different. This is a really super exciting one. It's very unique because these are 50 units. These are 4 buildings side by side on their own private courts, to 12 units to 13 unit buildings. I was just talking to somebody. I went to a multifamily retreat this weekend, and I ran into somebody that lives and invests out in St. John, New Brunswick. This is where the properties are. Between my business partner and I, as of right now, we have about, forget the number, somewhere like, around 50 units out there already, mostly in St. John, but also in Moncton, New Brunswick. My business partner, Ben, lives out there in St. John. He's our operations manager. He does all the management, property management, operations, project management. He's an electrician by trade and runs our buildings on site there. He was telling me, I met with him this weekend, and he told me, he said, listen, I've been looking at buildings for the last 10 years out in St. John and buying commercial properties. I have never seen a portfolio like this that's come on the market. For you to find 50 units that are like literally side by side, one portfolio, but it's literally side by side, it's so rare. So it's really a unicorn kind of deal, and we're very excited. Some really key highlights about this deal is we're purchasing it under market value right now. It's $85,000 per unit here that we're purchasing at. The appraisal came back $400,000 higher than what we were purchasing. So that's very exciting. And then this will be a value add opportunity. So we are looking to go into every building and renovate. We're looking to do some of the major things. We're going to be changing heating source from the buildings, but we're also going to be upgrading electrical, plumbing, and then touching all the units, kitchens, bathrooms, flooring, paint, and making sure and really upgrading the whole portfolio to where it needs to be. So we're very excited about that. We're looking to double the valuation of this portfolio in the next 2 years. It also gives us the option to really tackle one building at a time, since it's 4 buildings, instead of vacating a whole 50-unit building at the same time as well. We do have a GPLP structure here, and I think I saw a question about that, so maybe I could answer that question here. I've done different styles of deals. It was Ian who asked. Hey Ian, how are you? I've done different types of structures for deals. Some of them are shareholders, corporate structures. This specific deal, due to its size, we are doing a GPLP structure. So for those of you who do not know, this is a partnership officially. That's how you structure it. We have the general partners and we have limited partners. So general partners are on the managing side. In this case, we have Ben and I on the official, and Danielle and Ernie have joined us on that GP side. We have limited partners, which ultimately are financial partners on this deal. We all own shares in this corporation, which is the business and the building and the portfolio. It is a 50-50 split between GP, LP partners. And again, limited partners, the word limited is in there because the only thing that it's a liability protection for you. If anything, happens, the only thing they would be losing would be the amount that you have invested into the deal. Nothing like that has ever happened and won't happen, but that's what protects you there. While the general partner, in our case, the managing partners, have full responsibility for the debt on this property. So as you can imagine, we take this very seriously. We put together this deal. We work really hard at accomplishing all of our targets here. We're also very conservative with how we run our numbers because we want to ensure that we're over delivering, under promising and over delivering in all of our deals. These are some projections. I'm not going to dive in too much into these numbers, but I'm glad to have this conversation with anybody that wants to reach out and get some more information from us. But as you can see, we're looking at 2 exciting things here because this is a BRRRR strategy or value add strategy. We're looking to first 2 years, we're going to be putting a lot of funds into the deal. This is all equity partnership, by the way. We're not working with any other kind of structure here. But everything that we're putting back into the building it's increasing the value of your shares that you own in the building. It also allows us to, because of the active appreciation we're going to be causing, to refinance within a couple of years and pay quite a bit of your funds back at that point. We're estimating somewhere between 70% of your money back to potentially 100 in that time frame. I think that's it. We are very excited about this deal. We are closing soon. This is like, I was telling Danielle today, it's like, this is when it all happens. All the work that you put into something over the last 4 months is all accumulating right now in this next week or two. We're working with lenders and lawyers and putting it all together. It's crazy, very exciting. I cannot wait to have it under our belt. We do have a few, the way we function with this deal, we're getting a purchase plus improvements mortgage here. We've raised all the funds we needed. We brought in all the partners for the purchase part. We have some more room left on the renovation side. It's the same exact structure. And we have some, we're looking to have those funds in as soon as possible so that it's in the account for the lender to see as well. So we have 3 spots left, I believe, on the LP side. If anyone's interested, please reach out to us and ask for some more information. We're looking at about, we're estimating about 50 to 60,000 per unit here. And that the reason being is we are doing major renovations here. We are upgrading the electrical service for the whole building. We are upgrading plumbing for the whole building. We're upgrading appliances. So we are also adding balconies too. We are doing a full repositioning of this portfolio. We know what the final product is going to look like because the construction company we've hired to do the project has done very similar projects very nearby throughout St. John, and we've been able to walk through and see what those buildings look like, what they appraised at a refinance, and what the rents they're getting are. So we have proof of concept in the area. We're looking to do the exact same model that they've done in other portfolios. A couple of people have asked about the cap rate. Okay. How do you find out what the cap rate is in an area? Your best source for that is your mortgage broker. So you want to contact commercial lenders because they're the ones that are going to be financing your building. Something that I do, a little trick of the trade, that's something that I do on all of my buildings, is the moment I'm quite interested in a building, I will take all the information that I need, which, I can, that's some further education we can give you. What is it that you need here? And I send it to my lenders, and I have specific picked out already lenders that, again, something else that I can teach you at some point. And I'll send the information over to them. I already know what the cap rate is in an area because I would have had those conversations ahead of time. And ultimately, what's the cap rate that the area is trading in? Appraisers are gonna know that information, so will lenders. So 2 sources where you find that out.
That's a really good point. So Suman is asking, NOI excludes both first and second mortgage costs?
Yes, any debt servicing that you're doing to the property. So any mortgage products, even a VTB or private loans.
And then Joshua is asking, is 18 to 20% ROI annualized?
Yes.
Kim is asking, what are our thoughts on the MLI Select program?
Yeah, I love it. That's actually how we're planning to refinance this 15-minute deal in 2 years. We've already, the way we're applying for this mortgage, it's already preset to refinance with, ultimately we won't submit the application until we're about 6 months out from completion. But we love the MLI Select program. It's just opened up so many opportunities. We are going to be looking at their efficiency ratings as well, and ultimately trying to get the highest loan to value and the longest amortization we can at a refinance.
So Ian is asking, how do you hold the property corp? Okay, so we
I covered that one.
Yes. And then Amy is asking, can you repeat what percentage return your investors receive?
Specifically for the 50 unit, in general, we target somewhere between 15 to 20% year-over-year ROI. For this specific project, our lowest projection right now, it's at 18% return on investment year-over-year. And the reason is the BRRRR, that huge value add. Technically, if you're investing $100,000, it's only invested for a couple of years. You get some of those funds back and you have a smaller amount or potentially none of it invested for the next 5. So that really brings your ROI up here.
Oh, David is asking, can you invest with RRSP or LIRA?
Unfortunately not. Usually registered funds are used for mortgage products. In this case, we are, the funds that we're receiving from limited partners are for down payments, closing costs, and fees involved, as well as the first 25% of renovations. So no registered funds, unfortunately.
Okay, Jason is asking, can you explain what's the reason you're looking for more investments only for the renovation side? What's the difference?
There's no difference. I guess all I'm trying to say is we have funds to close on the building. We are raising not only for the closing of the purchase of the building, we're also raising for the renovation. The purchase plus improvements mortgage, the lender is giving us 75% of purchase price and 75% of the renovation costs. So and this is interest only loan for 2 years. Actually 30 months is a term. So it really gave us a really unique opportunity here to raise. We need to raise the 25% to close, and we need to raise 25% for the construction cost. That first 25% goes into the building first, and then we do construction draws from the lender. This is an A lender that we're working with, so that's also a very exciting opportunity too.
Awesome. Suman is asking, what recommendation you would give people who are just starting out in multifamily?
Yeah, it's a good question.
Yeah, that is a good question.
It's so hard to put yourself like right at the beginning. I find that a little hard to put yourself right in the beginning. I think what I've been saying to a lot of people lately is do a strategic partnership on your first one. Mm-hmm. Reach out to somebody that has a portfolio already, that is working and operating in the market that you are interested in, and have some really good conversations with them and offer some value add. If you have I have no money, I don't have any money to invest. If that's the case, then offer something else to add value to them. But do a strategic partnership on your first one, because I think that brings a lot of value to both people, and you will probably avoid a ton of headaches and not knowing the process by partnering with somebody who's done it already.
That one, Kim, does the affordability criteria work in your project as well?
We are looking at the affordability as well. We actually just had a conversation with the city of St. John today. I'm also doing a development project in St. John, New Brunswick. We're building a purpose-built rental there. We had our pre-consultation with the city this morning with city officials, and we talked about the affordability criteria and how encouraging the city is of that, and how we're going to be implementing in our deals as well. So that is something that we're looking into the select program with CMHC too.
Just go through. So Sean is asking, what happens if unexpected major renovation costs come up? Do we have to pay into that? I think we, as in maybe like limited partners, I think that's what Sean means.
Yeah, so we have multiple touch points to avoid any major calls from happening. Ultimately, we've built in quite a significant reserve fund as well as contingency plan here for our renovations. We have also, another way that I do this to mitigate risks is just constant touch points with the construction financial. We are hiring somebody that's going to be just doing the books with the renovation side of things. We also have the A lender themselves are doing audits, financial audits, because they're investing according to what we're doing there. So there's going to be a couple of other layers there that I really enjoy as well, that we have that in place. But let's say something completely out. Obviously, we have insurance in the portfolio as well that we can always reach out to. If it's something else way beyond our control, we'll look at other options before we do what we call a cash call. We're going to look at a way to get additional loans to cover any major expense that may affect the cash flow in that case. But that's something that we would look into doing instead of asking. On our LP agreements, if something were to happen really outside, both partners would put some funds into it if needed, but has not happened to us ever. And I make sure to put a lot of touch points and mitigate our risks as much as we can.
Okay, I think we're going to do one last question, and it's by Sean as well. So what happens if rents forecasted don't come in as planned?
Yeah, so ultimately the biggest thing that happens when the income is not there, it affects the valuation of the building, which affects the refinance amount. That's what that does. But this is also why we give you a range, because we already kind of go through that. First of all, we have an appraisal, an after repair value appraisal from, that comes from somebody that's an expert in the area in the commercial. So we feel really confident in what he's providing. Secondly, we have actually had a chance, like I said, to verify brand new buildings that have been serviced by the construction company that we're hiring here. And we've been able to verify their rent roll. So I know what they're getting for rent on their units. And we're going to be offering the same things in these buildings. So I know what we can get. We also have, like I mentioned, around 50 units out there between my business partner and I. So we're renting these every day. We know what we can get for rent in the area. So that's some of the things that just brings us our confidence level where we're going to be. But we also gave you a range, and the range is based on income. It's like, hey, if we can only get about, $1,200 for that kind of unit, if we were able to get what we think we can get for it, or we know we can get for it, which is about $1,400 to $1,450, that's where your range in returns come from and in refinance amount.
Okay, I think that's it for today. I think we're a little bit past our time. So I just want to say thank you for everybody that's joined us tonight. Thank you guys so much for the great questions. And if you have any other questions or you want more information on our live 50 units, please reach out to myself or Adriana. You can DM us or email us with the title Invest 50. And we're happy to set up a call or answer any of your questions. So that's it for today. Adriana, any last words? I see a lot of thank yous, very educational, and they've lots of learning here. So thank you guys for being here.
Yeah, thank you so much. It's always a pleasure. Even if you're seeking a bit more education on the space, feel free to reach out. We're here I feel so grateful to be where I am right now. And I'm so grateful to be able to also pass knowledge on and add value too. So thank you for joining us. And I look forward to chatting with you guys more.